The emergence of cryptocurrency as a prominent asset class has drawn investors looking to diversify their holdings. Digital currencies are a viable alternative to conventional investments because of their distinct features and potential for substantial profits. But the crypto market's intrinsic volatility demands a calculated approach to diversification. Investing in cryptocurrencies and blockchain-related assets allows investors to take advantage of market trends, reduce risk, and improve their overall approach to investing. This article examines the important functions that cryptocurrencies perform in portfolio diversification. Number 7. Low correlation with traditional assets. In order to assist investors comprehend how various assets move in relation to one another, the idea of correlation is essential to portfolio management. It has been noted that there is little link between cryptocurrencies, especially Bitcoin and Ethereum, and conventional asset classes like stocks and bonds. This implies that cryptocurrencies might not experience the same pattern during stock market downturns, which are frequently brought on by economic indicators like growing unemployment rates or geopolitical tensions. For instance, during the COVID-19 pandemic, Bitcoin and other cryptocurrencies saw periods of extraordinary growth as investors looked for alternate stores of value in the face of economic uncertainty, while many equity markets saw significant declines. This behavior can be linked to numerous variables, including the decentralized structure of cryptocurrencies, which insulates them from traditional market pressures and investor sentiment that often drives stock prices. Investors can potentially increase returns and lower overall portfolio volatility by including cryptocurrencies in a diversified portfolio. In comparison to portfolios made entirely of traditional assets, historical analyses have demonstrated that those with a small allocation to cryptocurrencies not only show lower risk but also achieve superior risk-adjusted returns. This diversification effect can be particularly beneficial for long-term investors looking to weather market fluctuations. Number 6. Enhanced return potential. The main reason for the appeal of cryptocurrencies is their potential for extraordinary returns, which can greatly improve the performance of an investment portfolio. In the past 10 years, cryptocurrencies have outperformed almost all traditional asset classes, with Bitcoin, for example, rising from a few cents in 2010 to over $60,000 at its peak in 2018-2021. This tremendous price increase has attracted a wide range of investors, from institutional investors seeking long-term growth opportunities to retail traders seeking quick profits. The factors that have contributed to this potential for high returns include the limited supply of many cryptocurrencies, such as Bitcoin's 21 million coin cap, growing institutional adoption, and growing interest from mainstream financial markets. The demand for digital assets is probably going to keep growing as more businesses start using cryptocurrency as payment and as financial products like Bitcoin ETFs become more popular. Furthermore, new opportunities for investment and profit-making are created by the cryptocurrency ecosystem's quick innovation, such as decentralized finance services that let users lend, borrow, and earn interest on their cryptocurrency holdings. Thus, investors can profit from these high-growth prospects while distributing their risk exposure among several asset classes if they judiciously allocate a portion of their portfolios to cryptocurrencies. Number 5. Risk management. A key component of investment is risk management, which entails recognizing, evaluating, and ranking risks before coordinating actions to reduce or manage their effects. Effective risk management is especially important when investing in cryptocurrencies because of the asset class's inherent volatility and unpredictability. Experts in finance frequently advise investors to commit a small portion of their whole portfolio, usually between 1% and 5%, to cryptocurrencies. With this cautious strategy, investors can benefit from the potential gains of digital assets without taking on an excessive amount of risk. Investors can reduce the risks associated with any one asset category by diversifying their holdings over a range of asset classes, such as stocks, bonds, real estate, and cryptocurrencies. Additionally, the effects of market volatility on cryptocurrency investments can be mitigated by using techniques like dollar-cost averaging, which involves investing a certain amount at regular intervals. In addition to lowering the emotional strain that comes with attempting to plan market entries precisely, this methodical technique enables investors to progressively increase their exposure over time. Additionally, by automatically selling assets when they hit a preset price level, techniques like stop-loss orders can assist preserve capital under unfavorable market conditions and guard against large downturns. Number 4. Hedge against economic crises. Many investors are using alternative assets as hedges against inflationary pressures and economic crises in an increasingly interconnected global economy that is marked by uncertainty and volatility. This perspective is being used more and more to cryptocurrencies because of its special qualities, particularly their decentralized structure and limited supply, such as Bitcoin's 21 million coin cap. Because of these characteristics, they are desirable choices for people who want to safeguard their wealth from inflationary tendencies or currency depreciation, which gradually reduce purchasing power. For example, fiat currencies may depreciate in comparison to assets having a restricted supply, such as gold or Bitcoin, when central banks implement expansive monetary policies such as quantitative easing that dramatically expand the money supply. Many investors have turned to cryptocurrencies as a way to protect their capital from diminishing purchasing power as a result of the recent spike in inflation rates in some regions. Furthermore, when people look for options outside of established financial systems that can be impacted by political unrest or sanctions, geopolitical concerns may raise demand for cryptocurrencies. Investors may be able to increase their resilience against the systemic risks connected to fiat currencies and conventional financial institutions by adding cryptocurrencies to their portfolios. Number 3. Speculative opportunities. For investors that are prepared to actively trade or make investments based on market movements and sentiment shifts, the speculative nature of cryptocurrency markets offers special chances. Cryptocurrency's quick price swings can result in large, short-term profits for traders who are able to spot bullish patterns or take advantage of market momentum. For instance, prices may rise sharply in a matter of days or weeks during bullish periods that are fueled by good news, such regulatory approvals or technology developments, providing profitable opportunities for profit-taking. However, there are significant hazards associated with this volatility as well. Prices might just quickly fall as a result of abrupt shifts in investor attitude brought on by unfavorable news or regulatory announcements. Strong risk management techniques, including placing stop-loss orders, should be used by investors hoping to take advantage of these chances in order to guard against unforeseen declines and optimize possible profits during bullish movements. Making educated trading selections and gradually improving investing methods also depend on keeping up with market trends, particularly technological breakthroughs in the Bitcoin industry. Following reliable news sources and participating in online forums can yield insightful information on market sentiment and new trends that could affect Bitcoin pricing. Number 2. Regulatory considerations. Investors must navigate the complicated and ever-changing regulatory framework surrounding cryptocurrencies, which offers both opportunities and obstacles. Different nations have taken different stances on regulating cryptocurrencies. These range from complete prohibitions on specific activities such as trading to encouraging frameworks that promote investment and innovation in digital assets. For example, investor behavior can be greatly impacted by the clarity of regulations governing the taxation of cryptocurrency transactions Ambiguous regulations may discourage market participation because of concerns about potential legal ramifications or tax obligations resulting from capital gains on trades or income from staking or yield farming activities. Investors need to stay alert for any changes that can impact the legality or value of their holdings as governments struggle with the best way to regulate digital assets, taking into account issues with consumer protection, money laundering, fraud prevention, and market stability. Effectively navigating the Bitcoin market requires an understanding of these regulations. Investors should keep up with national and international events to predict how regulatory changes may affect their investment plans. Getting involved with trade associations or advocacy organizations that support appropriate regulation can also yield insightful information about new developments in Bitcoin legislation. Number 1. Lack of income generation. The value of cryptocurrencies is mostly determined by market demand and speculation, rather than cash flow generation from underlying business operations, in contrast to traditional investments like stocks that pay dividends or bonds that pay interest. For investors looking for consistent income from their portfolios, this feature adds another level of risk and fundamentally separates them from other asset classes. Staking in proof-of-stake networks and yield farming in decentralized finance are two examples of more recent financial products that enable investors to profit from their cryptocurrency holdings through a variety of mechanisms such as lending out assets. But each of these options has risks and complexities of its own that should be carefully considered and understood before participating. Investors should assess how the absence of steady income generation fits into their overall financial objectives. Those who depend on steady income may need to shift a larger portion of their portfolios toward income-producing assets while keeping a small amount of cryptocurrency exposure for possible long-term capital growth. Investors can capitalize on the potential of this dynamic asset class while juggling their overall investment objectives by comprehending the distinctive features of cryptocurrencies and implementing efficient risk management techniques. If you liked our video, please hit the like button and subscribe to our YouTube channel.